My name is Gemma Yates. I'm the Investor Engagement Lead here at ACCR, and I'll be hosting today's webinar. I would like to start by acknowledging the First Nations people of the land that I am on, the Gadigal people of the Eora Nation, who are the traditional custodians of this land. I would like to pay my respects to elders, both past and present. So thank you for dialing into the Origin AGM webinar today. We have allotted an hour for this session. And I also did want to flag that we are recording this webinar. So we'll just go to the first slide. We'll start with a short introduction from Harriet Cater, who's ACCR's Australian Climate Lead. Our Chief Scientist, Dr. Dimitri Lafleur, will then provide a short update on the latest 1.5 degree pathway science and also talk about what that means for the oil and gas sector. ACCR's carbon analyst, Alex Hillman, will provide an overview of our Origin CTAP analysis and also update you on our voting recommendations. We should have 20 minutes for Q&A at the end of the webinar, so please add any questions as they arise into the chat box. Just also be aware that you can ask them anonymously if you wish. If you do have any follow-up questions after the webinar, my contact details are on the next slide. So please just get in touch and we can get back to you straight away. It's also just worth mentioning that the investor engagement team at ACCR includes myself and my colleague Martin Norman, who is Norway-based. He obviously sits in a slightly better time zone for many people calling in today. So if there is anything that you would like to discuss with us at any time, please just reach out to Martin or myself. We are here to help. And so without further ado, let's kick off with a short introduction from Harriet Cater. Thanks, Harriet.
Thanks very much for that, Gemma, and thank you everybody for joining us. We thought it might be helpful to provide a bit of a reflection on what's happened with Origin in the last 12 months. It's been a big 12 months for this company. So in August of last year, the company committed to provide a say on climate. I think on the very same day, ACCR filed a shareholder resolution seeking that the company commit to align its CapEx with a 1.5 degree pathway. We were really targeting the company's capital allocation to oil and gas exploration in the filing of that shareholder resolution. So particularly focused on their activities in the Beetaloo Basin, the Canning and the Cooper. At the October 2021 AGM, we were really pleased that 44% of shareholders supported that shareholder resolution. I think it was a result that surprised Origin. That was apparent in the chair's comments at the AGM and was really welcome level of support from shareholders. So thanks to those who voted in favour of that resolution who are with us today. Then in February of 2022, Origin somewhat surprised a few people, certainly those in the energy market, by announcing that it was bringing forward the closure of the Oraring coal-fired power station. From potentially as early as August of 2025. So that was bringing it from 2032 to potentially as early as 2025. So that also has a really significant impact on the decarbonisation pathway for this company. In August of this year, we filed a shareholder resolution seeking that Origin include, better reflect climate change in its financial statements. Including by the inclusion of a 1.5 sensitivity in its financial statements. And that's consistent with the new Climate Action 100 net zero benchmarks, accounting and audit alignment indicator that was launched for the first time this year. Also in August, Origin published its Climate Transition Action Plan, the CTAP, which has been put forward for the vote for the say on climate at the October AGM. ACCR was pretty concerned by this initial release document because it very specifically and stated multiple times through the CTAP that it excluded Origin's exploration activities, which have the potential to unleash a material amount of carbon pollution. Then last Friday or thereabouts, the notice of meeting came out for the Origin AGM. And whilst the company did not support our shareholder proposal for inclusion of the sensitivity analysis in the financial statements, it did essentially commit to doing that for its operating assets from FY23. So the reason it didn't support the resolution was because we thought that sensitivity analysis also be performed for the company's exploration assets. However, about the next working day on, I think I've got my dates off, but Origin made that significant announcement that it was going to exit the Beetaloo, Canning and the Cooper-Eromanga Basin exploration. That consequently, last week, Alex and myself and our colleague Naomi very hurriedly redrafted our analysis of the CTAP because this had a material implications for our for the company's climate plans and our associated analysis. And then, as of today, Dimitri, drum roll, ACCR has elected to withdraw the accounts and audit resolution that we filed with the company. Alex will provide further detail, but it was our assessment that based on that commitment in the notice of meeting and the subsequent exit from those exploration assets, that Origin was doing as much as it really could, or had committed to as much as it could with regard to that ask. So yeah, a fair bit's happened in these last 12 months, and definitely some things to celebrate. But the devil is in the detail, and that's what we have Dimitri and Alex here for. So I'm going to hand back to them. Thank you.
Yeah, I'd like for this section of this, the webinar, I'd like to give an update on 1.5 degree scenarios and what that means for oil and gas in general. And I'd like to start with the main takeaways here from this section. Within this section, you'll see why new oil and gas exploration is not compatible with 1.5 or the Paris Agreement for that matter, and that it is also not needed to meet future demand. You'll see that 1.5 degree consistent scenarios show that emissions from the energy system need to decline substantially in the order of 40 to 45%, and that both oil and gas use need to decline before 2030. Possibly by some 28 and 18%. And a separate takeaway message is a call to companies to disclose their 1.5 degree scenarios that they're using with specific temperature metrics, such as peak temperature, the temperature in 2100, and the societal and technological assumptions behind their analysis. Because these assumptions have a very large impact on the analysis. So it would be helpful if Origin would provide some guidance in this regard. To frame this part of the webinar, I want to step back and show you how we are doing in terms of limiting global warming. We're currently at around 1.2 degrees, and we see the environmental and social financial impacts of that warming already play out. In April this year, there was a Nature paper showing how we're doing tackling future warming by taking into account all the unconditional and conditional NDCs, so that's the national determined contributions, that are submitted by nations to the COP26 in Glasgow in November last year. Currently, under the latest legislated policies, we're on track for around 2.6. But if you take into account all the mid-century net zero pledges, the long-term targets that nations have made, it shows that just below 2 degrees is already possible. And this plot, you see the global warming on the y-axis versus time, and then dark blue, the line labeled A, the middle arrow there, shows you the warming if you include all the unconditional and conditional NDCs for which developing nations are relying on finance, for example. And this would lead to 1.9 degrees. If you take out the conditional pledges, and you only look at the unconditional pledges that don't have any strings attached, you would end up with 2 degrees. And if you include all the indices of Russia, which has a significant amount of hot air in there, Saudi Arabia, the methane reductions in the global methane pledge, you get to 1.8. And that is what IEA has done. So this is certainly not well below 2 degrees, as the Paris Agreement stipulates. And given the uncertainties in scenarios in general, the likelihood staying below 2 degrees is not high enough, as you can see in this little insert. the chance that the line A will exceed 2 degrees is around 40%, and that is not what the Paris Agreement asks for. But in my view, it does show you the traction, the emerging ambition to invest, and I think the acceleration of the transition is really visible. It shows how important rapid changes are that need to happen in the next decade to have a real shot at well below 2 degrees and pursue efforts to stay at 1.5. It's also worth remembering that in NDC is not the same as legislation. It's just a pledge, it's just a target, and the legislation has to follow. So with this in mind, I'd like to talk about 1.5 degree scenarios. And these scenarios become really important when you assess the requirements for the Paris Agreement alignment, which are holding temperatures well below 2 degrees. So that means we cannot go over 2 degrees at any point in the future. And we have to have some certainty that we stay well below it, not just below it. And secondly, greenhouse gas emissions need to reach net zero in the second half of the century. And you'll see that the only types of scenarios that do that are the 1.5 degree scenarios, where global warming peaks around 1.6. So it goes to this peak temperature and then it drops down again. And here on the left-hand side, you see emission profiles of some 2,000 scenarios towards 2100, but only the batch with the red line is consistent with limiting global warming to 1.5 in 2100. And this consistency is directly linked to a cumulative greenhouse gas emissions budget. And given the lifetime of CO2 in the atmosphere, like centuries to come, it's the greenhouse gas that is most important to reduce. And methane has certainly a role to play, but it's critical that we drastically reduce the CO2 emissions. So the remaining 1.5 degree CO2 budget is around 500 gigatons, but it comes with an uncertainty. It's possible that it's larger or smaller. And so the 500 gigatons hold true for a likelihood of 50% that global warming is limited to 1.5. Could be a bit higher, could be a bit lower. If we want to be more certain, say 67%, then that number is 400 gigatons. And so this budget is also dependent on how much other greenhouse gases are reduced. If we can reduce shorter-lived greenhouse gases, methane, for example, quicker than the models suggest, then the CO2 budget is a bit bigger. And because it's a budget, it also limits the amount of overshoot we can have. We cannot go to 3 degrees and ramp down because of the emissions embodied in that, that peak in between. So this is the order of budget that you have if you look at the long-term temperature goal of 1.5. There are infinite amount of possibilities to consume that budget, but in reality, the possibilities are bound by which present we have today and what is possible in the future. And these possible futures have everything to do with the assumptions around population growth, economic growth, decisions how humankind envisages society and the natural environment. And from this graph, it's clear that very drastic actions have to be taken in the next decade. Now, scenarios are projections based on outputs of models that aim to capture what the human impact is on the physical environment and the societal choices that we take. And so there's a lot of scenarios out there, including company scenarios, and all of them have different and sometimes very similar assumptions. And I'm going to focus on two classes here, and that's the IEA and the IPCC scenarios. The IEA net zero scenario is a 1.5 degree consistent scenario. So a study in Nature Communication this year assessed some company and institutional 1.5 degree scenarios, and the IEA NZE scenario, the green line here, does achieve the long-term temperature goal of 1.5 and has a limited overshoot, peak temperature of 1.56 in 2045. The IEA model couples different models together to see what the impact is on societal decisions, the decisions that the impact of decisions on emissions, on greenhouse gas concentrations, on GDP. The downside here is that it's just one scenario. So the assumptions behind it are really important to be aware of. And so it uses population growth that is in line with the IMF. It projects a world economy that is some 45% larger in 2030 than 2020, and twice as large in 2050 than in 2020. It assumes some technological mitigation levers like CCS, but on the lower end of what has been used in the literature. And the same holds for BECCS, bioenergy, CCS, and direct air capture, DAC, and also for bioenergy in general. The flip side of this is that it relies more heavily on the role of energy efficiency and on hydrogen and the uptake of solar and wind. So a very rapid electrification of society. And so the outcome of this is that emissions in the energy system have to decline by 43% by 2030. The use of unabated coal, oil, and gas have to decline by 58, 28, and 17% by 2030. And that comes with a very rapid renewable growth and hydrogen production ramp up after 2030 because of this very rapid decline. There's also no need for new mines, new extension of mines, and no new oil and gas. So moving to the IPCC, the main difference between the IEA and the IPCC is that the IPCC has a range of scenarios. The IPCC looks at the full picture, not just energy, but the energy, of course, is part of it. And the IPCC scenarios are based on outputs of integrated assessment models, IAMs, and effectively a selection of modules that interact with each other. And so the modules make assumptions on, again, population growth, economic growth, the resource use, technological change, mitigation policies. And in fact, it's quite similar to what the IEA does. But as a batch, as a range of scenarios, they provide a very good guardrail of what is possible. And the plot here shows you the different 1.5 degree scenarios in gray lines, and with that total uncertainty band in light blue, showing that there is still a small chance that we would exceed 2 degrees. Now, scenarios are projections, as said, and they are not perfect, of course not. And so the models have their shortcomings. They exclude market failures. They don't handle deep uncertainty and extreme risks well. They look at a best average outcome, whereas the Paris Agreement takes the perspective that if there are actions that strongly limit the possibility that disastrous outcome could occur, and these come at a moderate costs, then they should be undertaken. Another thing to be aware of is the median values. So IPCC scenarios come with a range, and a median value of those doesn't tell you much because it takes into account the scenarios that may have assumptions that are fairly speculative. And so there are ways to assess how likely scenarios are or how reasonable they are. They are all possible, but how reasonable are they? And so that has been done quite by a few groups to assess how reasonable certain assumptions are. Is there a likely upper threshold that can be found for certain things? And so I'm lifting out two groups here, a paper by Wazowski and a report by Climate Analytics that have looked at assumptions around specifically technological mitigation levers like BECCS, the role of afforestation, the dependence on energy efficiency, how quickly you can ramp down carbon intensity, for example, methane emissions, how quickly they can go down. And if you filter those scenarios on those thresholds, you get a very different picture than the median values that are floating around. So if you look at the filtering that Climate Analytics has done and what that means for coal, oil, and gas use, you see that it has to decline by 80, 27, and 29% on 2020. by 2030. And if you apply the Wazowski filtering on the IPCC, the latest IPCC scenarios, you end up with 68, 28, and 18% reduction of unabated fossil fuels, like coal, oil, and gas. So that is very different than the medians that are floating around. So I think it's really important, informative, but also really important for investors that companies disclose temperature metrics to show that their scenario is indeed 1.5 degree aligned, and disclose the assumptions that led them to this specific scenario, just because the impact of the assumptions is so big. And I'd like to finish with where new oil and gas sits in this. I already hinted at it, that it basically has to be absent. There's multiple lines of evidence that have shown that a long-term 1.5 degree temperature goal of the Paris Agreement is not compatible with approval of any new oil and gas projects. The IA talks about no approval of new oil and gas, but it also implies no need for further exploration. Trout et al. This year, that I was part of, showed that developed oil, gas, and coal extraction would push the world already beyond the 1.5 degree budget. And yes, it include coal, but the committed oil and gas development, so that's oil and gas that is FID'd, would already consume 85% of the remaining 1.5 degree budget. And so nearly 40% of the reserves within existing fields and mines should stay in the ground. And this is echoed by the Working Group 3 report of the IPCC and Tong et al. In Nature, that showed that emissions from existing fossil fuel burning infrastructure, so that's power plants, transport, industrial plants, is larger than the remaining 1.5 degrees budget. And so it should be a warning sign for investors that existing assets are already at risk. So that's what I wanted to show. As said, there's quite a lot of evidence that new oil and gas exploration is not compatible and that it's not needed to meet future demand. A 1.5 degree consistent scenario show that emissions from the energy system need to decline substantially in the order of 40 to 45%, and that both oil and gas need to decline before 2030, as shown possibly by 28 to 18% or more. And a separate takeaway message is a call to companies to disclose specific metrics, such as peak temperature and temperatures in 2100, and the societal and technological assumptions behind their 1.5 degree analysis. That's where I want to leave it, and I'll hand over to Alex.
So I'm Alex Hillman, been with ACCR for about a year now, after spending a decade in oil and gas. And I want to talk through, the key votes at this year's Origin AGM. So the Say on Climate vote, a director vote, and accounts and audit resolution, which, as Harriet's told you, it's not hot off the press. It's even before it's got to the press that we've withdrawn that resolution. In a really high level, in order to assess the CTAP, the Climate Transition Action Plan of Origin, we built an emissions forecast of theirs, and we overlaid that against a 1.5 emissions trajectory. So taking a steer from Dimitri that we need to be clear about how we define our trajectories and our targets, what we've done here is we've taken a 1.5 degree scenario for Australia based off climate analytics work, which says a 50% reduction by 2030 in domestic emissions. And we've extrapolated that out to net zero in 2045. And then for the exported component of Origin's portfolio, so the LNG, they send principally to Asia. We've taken the IEA's net zero emissions trajectory for Australian LNG production. So we've benchmarked that to Australian emissions against 50% reduction against Origin's current Australian emissions, and then the NZE profile calibrated for Origin's current LNG export levels. So when you look at that red line, that's our view of what a 1.5 degree budget and profile would look like. And in keeping with our resolution from last year, that's supported by 44% of investors to align CapEx with the 1.5 degree outcome, our view is that Origin has actually done that. So if we take a fairly optimistic view of Eraring, where Origin has said that they'll close it as soon as 2025. If they do close it in 2025, there'll be 3 million tonnes below their budget out to 2065. So even a couple of months delay, we won't pretend that the model's accurate to a couple of months, but just to say it is very closely aligned. So, the emissions above that red line very closely match the white space below that red line. And then the other really big takeaway, as Harriet said, it's been a bit of consternation or a bit of rework in the last week, is Origin's role in gas exploration is worth a bit of a deep dive. So that's a quick overview of the climate report. One thing we try to do to make sure we're assessing climate reports thoroughly is use the Climate Action 100 benchmark indicators as a bit of a way to think through, all the aspects that should be in a report. Those traffic light bars towards the right-hand side is our view of what Climate Action 100 would score the current CTAP. So Climate Action 100 haven't actually assessed the CTAP yet, but that's our view of how they would. And as you can see, there's a fair bit of green here. So there's no red, there's a fair bit of green. Origin's come a fairly long way in the last year, especially actually in the last week. But this effectively forms the table of contents for the rest of the presentation, so I won't dig into it too much. So firstly, when we look at Origin's targets that they've set, so they've set a 8 million tonne reduction over 3 years. This is just for scope 1. So it doesn't cover all 3 scopes. When you look at it assessed against all 3 scopes and their emissions in all 3 scopes, it's just about 2% reduction per year. So the short-term target we don't see as 1.5 degree aligned and therefore not supportable. The medium-term reduction, you can see that green bar in 2030, and there's a tiny little smidge of a green bar in 2050. So that's notionally just showing that they're net zero by then. Both of those 2030 and 2050 bars are below the red line that we've modelled as their fair share of a 1.5 degree budget. And just for a bit of clarity, what we've shown here is an absolute version of their 2030 target. Origin's also set an intensity version. So it's at a 40% reduction or a 20 million tonne absolute reduction. We haven't modelled Origin's forward-looking energy sales, so we can't actually validate the 40% reduction because that's an energy intensity basis, but it should be consistent. So we're fairly comfortable with their medium and long-term targets. So as we mentioned a few times, Origin's role in exploration has been quite fundamental to their portfolio. When we have a look at the scale of their exploration, it's absolutely vast. So they've been involved in 4 basins, three of which are active. So the Beetaloo, the Cooper, Eromanga, and the Canning Basin. And if you have a look at that waterfall chart on the right, the Beetaloo, it was developed at an optimistic case, as in a high production case. It'll be over 1 billion tonnes of emissions cumulative. And that's the smaller of the 3 basins. So the Cooper is another 2.5 or so, and the Canning up to 6 billion tonnes of emissions, again, at that high case. So the numbers behind that are quite rubbery. Again, won't pretend it's more precise than it is, but just to give you a sense of scale of the potential impact of the basins they've been unlocking, absolutely huge. So massively dwarf our view of Origin's 1.5 budget, and actually even bigger than all of Australia's 1.5 degree budget. So those emissions from those basins would largely be overseas, but when you compare it to Australia's domestic target, consistent with 1.5 degrees, those 3 basins could actually result in a lot more emissions. And one thing that's really important for institutional investors, Origin's made a decision to get these projects off their balance sheet, but that if they're still developed, then the climate impact of those developments still occurs. And so as an institutional investor with a diversified portfolio, physical climate change impacts on a lot of your stocks will probably be significantly more than the physical impacts on Origin's infrastructure. So there's a split incentive there between Origin's decision-making and the decision-making of an institutional investor. And we think that should be front of mind for these investors. We'd also point out that as part of the divestment announcement for Beetaloo, Origin still has they're still receiving a royalty. So if there's a successful development outcome, they will receive 5% of all revenue from Beetaloo production. And they're also have signed up for an offtake agreement. So they're receiving revenue, but also providing an offtake agreement, which will help develop Beetaloo. So instead of, so Origin said they're not going to develop these basins. That's a constructive start. Their attitude, they've announced they're divesting Beetaloo and a strategic review of the other two major basins with a view to exit those as well. So instead of developing or divesting, what we would be recommending is that they actually help to wind these basins down and prevent them being developed. So that would involve ceasing capital investment beyond whatever legal obligations they have as part of their exploration permits, committing to not pursuing production licenses at the end of their exploration license, actually working with governments to ensure these resources aren't developed. So there's some ways that the land tenure can be changed, which prevents future development. So we acknowledge that's a fairly bold position. We're not seeing a lot of discussion about that, but with unprecedented times and considering Dimitri's presentation about how much of the carbon budget is being pursued and how there's no room for new developments, we think that is appropriate. And Origin's also in a position where its exploration forms a tiny part of its balance sheet. So about 1%, so post the Beetaloo divestment, about 1% of its balance sheet is taken up by the exploration acreage. So it's actually not a big part of its balance sheet, but its potential impact on future emissions is ginormous. So you have this leveraging effect of Origin making this decision as a leader in this space. So when we look at Origin's disclosed decarbonisation strategy out to 2030, so they speak about 3 pillars. So enabling customers to decarbonise, growing their portfolio of renewables and reducing emissions from existing operations. We've got a lot of time for the first two, well, for most of this, especially the first 2 pillars. So the low carbon products and solutions, they're particularly good with managing large customer base. And so leveraging that customer base into selling things which support the energy transition, such as shared electric vehicles and solar panels is great. Their investment in Octopus Energy, so they own a 20% stake of a UK-based company, and that UK-based company is an electricity retailer and they only sell 100% renewable electricity. And Octopus also developed a cracking customer management system, which they're now licensing around the world to multiple retailers in multiple countries. There's a real benefit there. In terms of changing the portfolio, so growing their portfolio of renewables, they've got a target of 4 gigawatts of PV and renewables and storage by 2030. And they've also started developing a virtual power plant. So providing ancillary services to the grid. I think it's about 200 megawatts at the moment. They've got a plan to expand that by almost an order of magnitude out to 2 gigawatts. A bit further down the track, by mid-2020s, which may be a little ambitious, but they're laying some groundwork, looking at green hydrogen and ammonia. ACCR's view on hydrogen is it should be green, so it may not have a large market, but hydrogen made out of natural gas or fossil gas isn't a useful step. So great to see Origin focusing on green production of hydrogen and onto ammonia from there. In terms of reducing the scope 1 emissions, so reducing emissions from existing operations, the early closure of Eraring is great. It was scheduled to close from 2032. So 7 years off that. 7 years sounds like a lot, but when you think about it as 70%, I think it sounds even more significant. They have caveated the language about exactly when it's going to close a little bit. So we'll be keeping a close eye to see if that slips. Because that is really key to them meeting their 1.5 degree budget. And then the gas operation. So as the upstream operator and a major owner of Australia Pacific LNG facility in Queensland, they have said that they're going to be focusing on reducing methane emissions. So I think their thinking there is that an LNG facility that's already built, there's limited opportunity to change its main CO2 emission sources. And so they'll be working on methane, but methane emissions aren't a large part of their operating footprint, and they're not at all reflected. Their target does not attempt to look at scope 3 emissions of methane or otherwise. There are other options that could be considered for an LNG facility, such as displacing on-site gas-powered electricity with renewables, but they don't talk to that as an option. But hopefully they can soon. In terms of capital allocation, so just remind everyone that last year, 44% of institutional shareholders supported an ACCR resolution, calling on Origin to align capital with 1.5-degree pathways. So they've said explicitly, or they've laid out some of their fundamentals of their capital allocation framework, and consideration of their net zero ambition is now going to be part of that. And also you can tell, although we have some reservations about their Beetaloo divestment, in terms of how Origin is allocating its own capital, it is very strongly aligned with a pivot away from oil and gas. And if we assessed it from a Climate Action 100 benchmark perspective, they would be required to make a commitment that they'd align their capital expenditure with 1.5-degree scenarios. And even though they haven't done that, their indicative guidance, it's not specific numbers or targets, but their hazy graph that they've included shows that their capital allocation will pivot away from thermal and upstream oil and gas in line with net zero emissions scenario from the IEA. In terms of climate policy engagement, so Origin issued an industry association review that concluded that there was no misalignment in both the high-level policy principles of all its industry associations, as well as the detailed advocacy. We don't agree with their conclusion. When we look at what some of these industry associations are saying, we don't think it's aligned with sensible climate policy. And independent analysis by Influence Map supports the view that some of their industry associations are not conducive to a safe climate outcome. Two in particular are the Queensland Resources Council and the Australian Petroleum Production and Exploration Association. So both of these quite recently have made statements very clearly counter to 1.5-degree scenario. And it's not just now that Origin has a sensible, defensible strategy to decarbonise its portfolio, funding advocacy that is counter to that actually puts their own strategy at risk. So it is a direct risk to Origin's own strategy. And so ACCR is saying if Origin can't work within these organisations to constrain their advocacy, it should exit both of these organisations. Irrespective of its membership of any industry associations, though, Origin should be taking a lead and advocating both positively and publicly for climate policies that support 1.5 degrees, obviously for the greater community good, but also just to support delivery of their own strategy. So in terms of climate governance, it's evident that climate change is being considered by the board. They had a 2022 strategy refresh, which their CTAP said that it had considered climate change, and you can see they've made a lot of big ticket items to support decarbonisation. And remuneration. So they've got 10% of their short-term remuneration is explicitly for Scope 1 emission reduction targets or delivery against their 8 million tonne target. They've also got 18% against their energy market strategy. So their energy market strategy is effectively a transition strategy. So we're giving them credit for 38%, so 28% of short-term remuneration being climate aligned. In terms of the long-term incentive equity grants for the CEO, 50% of it is towards non-financial metrics with a fair bit of board discretion. So even though there is a lot of board discretion, a lot of the metrics mentioned are relating to climate change, such as PV sales. So we think this remuneration is supportable, but it will be even stronger if that 2030 emission reduction target, which covers all three scopes, was more clearly embedded in both short-term and long-term remuneration. In terms of just transition, so announcing the closure of Eraring 70% earlier than it otherwise would have been is a genuine test of Origin's commitment to a just transition. So Origin have included in their CTAP page talking about some of their principles, and it's great to see that underlying all their principles is open, inclusive, and transparent engagement with staff and other stakeholders. And also one of their principles is positive policy advocacy around the just transition. So it's a great basis. Some of the things we'd be asking or suggesting investors speak to Origin about is how Origin is going to deal with Eraring's indirect employees. So they're roughly 500 staff, seem to have decent structure in place. but Eraring will have lots of indirect staff, so subcontractors, casual staff, for example. There'll be lots of other categories of employees dependent on Eraring, which should also be considered. And the Hunter Jobs Alliance has also put out a policy recommendation for a regional structural adjustment policy. So we think there's a lot of merit in that. And it's the sort of thing that it'd be great to see Origin get behind. It is largely at the principal level at the moment. We acknowledge it's a step forward. We would like to see more detail added and encourage investors to continue to engage with Origin on how they implement and deliver this just transition. In conclusion, for the CTAP, the Climate Transition Action Plan, Origin's climate plan is significantly improved and we think it's supportable. So we're recommending a vote for the climate plan with a caveat that continued engagement is required or is encouraged. So we'd like to point out that divestment of exploration assets is not decarbonising or not necessarily decarbonising those assets. And if you're an institutional investor with a diversified portfolio, we think you should be concerned about the physical impacts. And we think you should be raising that with Origin and recommending that they take steps to prevent the development of those basins. We think Origin should be acknowledging that APR and Queensland Resources Council's advocacy presents a risk to delivering their own strategy, and they should restrain or exit these organisations, as well as Origin itself publicly advocating for positive policies. And the just transition implementation that we just spoke about requires some additional detail. That's the CTAP in a nutshell. When we have a look at the directors that are up for re-election, we've done some screening on each of those. One of those stands out to us, and that's Greg Lalica. So as well as being a board member on Origin, he's CEO of a private oil company, Hillcorp Energy, which is based in Houston. So despite Hillcorp not being a very large producer or not being one of the largest producers of oil and gas, it's the highest methane emitter and has high CO2 intensity as well. So as a standout poor performer in the US, we think that Greg's role, and Greg shouldn't have a role on the Origin board because Origin as an operator of the upstream component of APLNG shouldn't have that sort of influence into them. And obviously as Origin's portfolio strategy diversifies and pivots away from oil and gas exploration and production, this sort of expertise is less and less relevant. So we would encourage all investors to vote against the re-election of Greg Lalica. So something dear to my heart is the accounting and audit resolution that we raised. So I think everyone now realises that climate risk is financial risk. So, you know, well before the Paris Agreement, well before TCFD, it was clearly understood that climate change presents transition risks to fossil fuel companies. Since it's a financial risk, it clearly belongs in the financial statements. So we first engaged with Origin a few weeks before they put out their financial statement, their 2022 financial statements. And it was impressive to see how far they moved from near silence in 2021 to, you know, a reasonable description of a 1.5 degree scenario in 2022. So they noted that their energy markets, they would expect to see upside. So there'd be no impairment in there. And for APLNG, they'd expect to see under an IEA net zero emission scenario, they'd expect to see an impairment. So they quantified the assumptions used to assess that there would be an impairment. They didn't, however, quantify what that impairment would be. And they were silent on their exploration. In the notice of meeting, they did announce a plan a commitment to improve their disclosures and a plan to talk about a 1.5 degree sensitivity. They did say, however, they didn't support our resolution on the basis that we were calling explicitly for the inclusion of their exploration assets. After their notice of meeting and after we submitted filed the resolution, they announced the divestment of Beetaloo and the strategic review of their other exploration assets. So now we see that exploration assets as much less significant than it was when we originally filed. And as such, we see, we have withdrawn the resolution. So we notified Origin just a couple of hours ago. And as I said, it's not hot off the press because it hasn't made it to the press yet. When we've discussed this accounting and audit resolution with a few stakeholders, one of the things we've had come to us is that is that Paris-aligned accounts is inconsistent with the Australian and international accounting standards. And just to avoid any uncertainty about that, we're not calling for Paris-aligned accounts. Paris-aligned accounts would mean that the reference case, the fundamental base asset values of the accounts are based on Paris-aligned scenarios. We are not calling for Origin to change their base case assumptions. We're just calling for Origin to publish a sensitivity. So, and disclose the impacts of that sensitivity in its financial statements from next year. So that's my slides covered. Shall I pass back to you, Gemma, to facilitate Q&A?
Thank you, Alex. Okay, so we've got 10 minutes on the clock and we've got a few questions coming in, so we might get stuck straight into it. So the first one, can you comment on new oil and gas compatibility with the well below 2 degrees goal of Paris? That might be a good one for you, please, Dimitri.
Yeah, I think this relates to the requirement of new short-term oil and gas in order to meet demand, particularly in Europe. There's a big difference between small new gas developments that may be able to be hooked up very quickly in the North Sea, for example, and very large projects that are about to be FID'd or have recently taken FID. These projects will come online in 7 or 5 to 7 years' time. And yeah, I think the European energy crisis is a short-term crisis that requires very immediate action. The prices are sky high, and I can understand that immediate additional gas is a requirement. However, I think in the longer term, it will result in destruction of additional gas, or destruction in LNG in particular. We already see that in because of the high price, countries are resorting back to coal because they can't afford the gas. And so in all likelihood, it would accelerate the transition in those countries. And I'm thinking about India, Pakistan, Bangladesh, and others. Europe itself is accelerating its transition to renewables. So I think the longer term impact is possible a reduction or a destruction in gas demand, which would effectively be in line with the Paris Agreement. And yeah, I think we have to remind ourselves that this transition is not going to be a linear transition. It's going to be very, very bumpy.
Okay, thank you for that. Next question, how does your analysis compare to the recently published TPI update? According to TPI, Origin is above the below 2 degrees scenario in the medium and long term. Look, I don't think we have seen the latest TPI analysis, but Harriet, do you just want to comment quickly on the differences in methodology between us and TPI?
Yeah, TPI, I mean, I know, Dimitri, you've had some fun with TPI methodologies for Shell. There are distinctly separate methodology. They obviously disaggregate companies and assess them on a sectoral level. So they'll do an assessment on the utility business as well as an assessment on the oil and gas business. I'm assuming when you're referring to the most recently published one, you're referring to the updated Climate Action 100 benchmark score. But yeah, we haven't dug into that scoring. We're not sure which of the recent announcements from Origin are reflected there. Very happy to take your details and follow up with some commentary after this evening.
Yeah, very happy to follow up.
Alex,
maybe just a bit of extra context. So as Harriet said, we rewrote the large portions of our analysis in the last week. When we still had Beetaloo included as scope as emissions for Origin, they're about 50% over their 1.5 degree budget. So that might explain any discrepancy, but yeah, we can get back to you.
So this is a pretty big question, but probably a good one for a discussion. Do you think the wind down approach is realistic? You're asking the company to forego earnings by selling their assets, which many investors may be against. So Harriet, do you want to open with the response to that one?
Yeah, I mean, I'll start, and I know that Alex and Dimitri will have something to add, but I guess we're really encouraging investors, and particularly universal owners, to take a really holistic view of this recommendation and to take into account the escalating risk that physical climate impacts present to their portfolios. and therefore the associated risks of unlocking new oil and gas basins. So we would argue that there is a financial imperative associated with backing such strategies. Alex or Dimitri, you might have something to add.
I'd point out that it's not. So they've got about $100 million worth of assets left in their exploration balance sheet. A few years ago, they wrote off $860 million for Poseidon. So I think I mentioned there was 4 basins. I only spoke about 3. The last one I didn't speak about because they did whatever exploration it was. They decided there's zero value, and they wrote off the whole value. So I think Origin's a really interesting case study because it's the value of its exploration is so low. And so that's one part of the answer. Another thing I think is relevant is we are seeing managed decline. Like even in Origin's portfolio, Eraring is a managed decline decision. So they've decided that this thing is not profitable. It has become a stranded asset. And in 2021, they wrote off, from memory, it was $1 billion. So about 10% of their net assets were written off because they had an overly optimistic view of fossil fuel futures. So I think there's a few reasons to think that further investment by anyone in additional fossil fuels isn't in investors' interests. And we think it's time for this sort of discussion to be had.
Very good, thank you. Have you had anything to add? Sorry, Dimitri.
Well, I was just going to add that I think the difference between now and say decades ago, that we are now playing with an additional constraint, which is this overarching physical constraint, which used not to be there. And now we have to take that into account. So the discussion is very different to just a normal, I think, capitalist approach, which is what I wanted to add.
Probably feeds nicely into the next question. Are there examples of where investors have played a notable role in the managed decline of an asset?
Well, a year ago, we collectively as investors voted 44% for Origin to align its capex with a 1.5 degree scenario. And since then, we've seen, Eraring, I'd point out again. So, there is a massive pivot in their portfolio. We're seeing the divestment attitude. It's not that big a step, I think, to a managed decline, considering the shape of Origin's balance sheet.
And we've seen it with BHP's decision with the Mount Arthur coal mine as well, obviously a thermal coal mine, but that the company was seeking to extend the mining license for that asset out to the late 2040s. And there was definitely a significant investor intervention, which saw BHP take the decision to cease trying to sell that asset and instead closing it up from 2030.
It's probably one for you, Alex. Do you take a position on how much Origin should increase its low carbon business, e.g. align with the energy mix in the IEA by 2039?
We take an emissions-led approach to this. So, as you can see, we've modelled what we think is their fair share of a 1.5 degree budget. And we focus on constraining emissions to that point. So, I personally don't have strong views on what Origin should do to support the other side of the ledger. But we'd obviously welcome them, implementing their strategy. I'll open up to anyone else.
Yeah. Okay, we'll move on. This might have to be the last question. So are you expecting other companies to also take up the 1.5 degree sensitivity analysis in their financial statements?
I think Harriet's going to leave that one to me.
Over to you, Alex. Yeah.
So one thing that's great about all this climate change in financial statements is Australia was a leader. So the TCFD came out, the recommendations I think were published in 2017. In 2018, the Australian Standards Board and the Auditing and Assurance Standards Board, I think I've got it right, issued a joint notice saying that climate change is material from a financial perspective. And it's actually really strongly worded, even if a company doesn't think it is, and even if when they assess climate change, there's zero impact. So this joint notice said that if stakeholders see climate change as material, it's material, irrespective of company calculations and company views. So Australia's been well ahead of this in terms of regulatory context. PRI, Climate Action 100, are now asking for this as well. So it feels like the momentum's there, but there's just been this kind of fear of going first, I think, is all that's stopped it. It's not a difficult ask. We saw Origin do the bulk of the work within a couple of weeks this year, and our sincere expectation is that, you know, now that Origin said this, that they are committed to it for next year, it's just going to become normal. If you're a fossil fuel company, at least on the ASX, probably globally, you're going to have to do a serious sensitivity analysis and disclose metrics in traditional accounting. Disclose impacts in traditional accounting metrics, and we think it will be normal remarkably quickly.
Excellent. Well, it is right on 5 o'clock. So I just want to thank everyone for dialing in. Again, if you have follow-up questions, don't hesitate to reach out, and hopefully we will see most of you again next week for the South 32 webinar. So if you don't have the details again and you'd like to dial in again, just get in touch and we'll send those through. So thank you everyone, and have a lovely evening or morning.